Good afternoon, everyone. Thank you for taking time to join us for this session on the Schedule F tax form. My name is Janet Wright. I'm a National Outreach Specialist with the FSA Outreach Office. And before I turn it over to today's presenter, I will take care of a few housekeeping items. First, at any time during this presentation, you can enter your questions into the Q&A box, and Guido will try to answer as many of those during this session as possible. This meeting is being recorded and will be posted to the farmers.gov/'s website. It takes a little time for us to get them transcribed and posted. However, once they are, you will receive an email letting you know that they're there. Previous webinars, upcoming webinars, and other tax ag information can be found on that website, and also information for our partners that are located at ruraltax.org and agftap.org. So with those announcements out of the way, I'm going to turn it over to today's speaker.
All right, well, thank you, Janet, and good afternoon, or good, everybody, from wet and chilly Lawrence, Kansas. That's where I make my home. As Janet said, this is going to be a discussion of Schedule F, profit or loss from farming, which is the form that we use to report farming activities for income tax purposes. And my quest, or the task today, is to have a line-by-line discussion. I have a lot of information. We're going to try to answer those questions throughout the presentation. And then if there are any remaining questions, as Janet said, we'll put those in the Q&A box and we'll see if we have time at the end. So having said that, everybody sit back, relax, buckle your seatbelts, make sure that your tray tables are up in the locked position, and we are off to the races. As Janet mentioned, I'm part of a group of Rural Tax Education. We are the National Farm Income Tax Committee, and there is some information that you could find on our tax website that discusses some of these topics, as you see there: disaster, weather losses, treatment of government payments, etc., for your educational needs. We also have a disclaimer. It's a standard disclaimer here that y'all can read. So what I want to kind of focus on today is what we're going to do. I'm going to define, from an income tax perspective, farms, farming, and a farmer, and then we're going to move into the Schedule F discussion on that entire form. The tax definition of a farm is going to be that it is a business that has a profit motive. Code section 2032, cap A, E4, and this is just pulled right out of the code. A farm includes livestock, dairy, poultry, fish, fur, fruit, and truck farms. It also includes plantations, ranches, ranges, oranges, and groves that are producing food, fiber, or fuel with a profit motive. This would include the crop farms, cattle ranches, truck farms, etc., orchards and vineyards. And you can see kind of a couple of those photos on the slide here, with corn growing in the lower right. And then in the center, we've got the harvested vegetables that may be coming from a truck farm. So again, the focus is income tax and what you need, and it is a business with a profit motive. So then it leads to the question, well, who is the farmer or who is the rancher? Well, the Internal Revenue Service publication 225, which is the Farmer's Tax Guide, defines a farmer or rancher as an individual who is in the business of farming. If you cultivate, operate, or manage a farm for profit, there's that profit motive again, and you're doing it either as an owner or a tenant. Now, originally the focus was on individuals, but we have grown, and farming across the country can get a little bit more sophisticated. So we also have partnerships or limited liability companies. Those are the LLCs. Those can be taxed as partnerships, or the LLC could also make the election to be taxed as a corporation. Corporations are the farmer, and we could also have estates or trusts that operate farms. And so one has to think about who is the farmer. And it may not be an individual, because they may be operating as an entity, let's say a corporation, so they could be a shareholder employee of that corporation doing the physical work. But when we look to who is the farmer, it's going to be the corporation and not necessarily the individual. And this is all, again, for income tax purposes. So that then raises the question, well, what are some of the activities that may not be farming? Well, if an individual provides agricultural operations as a service industry, such as custom farming or custom harvesting, and here in the picture, I've got a tractor that's going across the field with a disc, and they may be doing that as a service on a per acre basis. That is not even though you would say disking is a farm activity, and I would agree, but again, the intent of the business operator is to provide that service to the landowner, and that would be a Schedule C business, a non-farm business that has a profit motive. Again, trucking of farm commodities as a service to markets is not going to be a farm activity. You may do a little bit of it for a neighbor, and we'll talk about that when we have machine hire. And then processing of farm commodities into value-added wholesale or retail products is also not farming. So I've just got 3 examples here: cheese, cuts of meat, and wine production. Getting the milk out of the dairy cow, whether it be a Jersey or a Holstein or a Guernsey, and then taking that raw milk and then making cheese out of it, that cheese is not a natural farm product because it has gone through some kind of processing. Similar with cuts of meat and wine. So there is that process that goes through for that end product, either in the wholesale or the retail market. So just very quickly, some definitions for all of us to get on the same page as to what is or what is not a farming activity. And we just have here some examples. We got John operating a traditional row crop. Now he's got quite a gross receipts number, $950,000, and he's a farmer. Then we got Maria, next one down. She has specially constructed greenhouses, and she happens to raise mushrooms. Now, by the time she has her cost in and what she gets out in her net profit, she's got $10,000 in net profit. And if you look at gross receipts of $950 versus $30,000, this is a sizable economic difference. But Maria is still a farmer. She has a profit motive. And in this case, the scale is not going to be a factor. Just another example, and this is one of aquaculture, and this is Roberto raising Nile perch or tilapia. They're going to be harvested. They go to market as live fish. They're transported in special tanker trucks. He's going to be an aquaculturalist, which is a farming activity, and he's going to file a Schedule F to report the income and expenses. Likewise, we've got Jen. Jen is engaged in the business of farming. He raises his crops on there, but he's not raising it on any land that he owns. So he's a tenant. He's a tenant farmer. And so Jen uses Schedule F to report his income and expenses as well, because he is still considered to be a farmer. So those are kind of some of the definitions and kind of ideas. Now what I want to actually move into is Schedule F. And we're going to look at Part 1. And as you can see on the screen, this is the page 1 of Schedule F. Schedule F actually has 2 pages. Page 1 is for the cash method. And then page 2 is looking at the accrual method, making some accrual adjustments. You would not use Part 1 for the accrual. In my experience, about 99% or more are using the cash method. So I am going to focus on page 1 of Schedule F. Now, we use this form for the sole proprietor who is in a farm business, and this is the profit or loss from farming, and we would use this to report income and expenses. Now, Schedule F can also be used as a supplementary form for partnerships or LLCs being taxed as partnerships, corporations, trusts, and estates in which they report their farming activities. It's a really nice form because it kind of lends itself to report that farming activity in terms that make sense relative to the producer who is doing the actual farming. The first thing that we want to look at is looking at this information block that's at the top of Schedule F. And it would be the name of the proprietor. Now, the form presumes that we're looking at a sole proprietor, but again, it could be an LLC, it could be a partnership. We want to know who that is. We want to look at if it's an individual, then it's going to be a social security number that's going to be tied to that. So we have a social security number block. Then we want for statistical purposes and also trying to do some classification work either at IRS or USDA or at the Department of Commerce. There's a question about what's your principal crop or activity that's grown? Is it milk? Is it corn and soybeans? Is it vegetables? Is it cut flowers? What is it? And then you can see block B, that has the farm activity code. Now at the bottom of page 2 of Schedule F, there's a little section at the very bottom that provides a series of farm types. And with those 6-digit codes, and that's where that code would come from. Then the accounting method that's going to be used is cash or accrual. And as I said a moment ago, most folks are going to be using cash. And so you just tick that little box, cash. And then if you've got an employer ID number, if we have employees, or if we're an entity such as a trust or an estate, or we're a corporation, we're going to report this income and expenses using that employer ID number that we would have there. And then there are 3 additional questions that you can see listed there. That's E, F, and G. And E asks, did you materially participate? The reason for that question is there could be a limitation if the answer is no relative to a passive activity. Generally, farms are not passive, but they can be, and one needs to be aware of that. But I would think that most folks on the call today are going to be active and material participants in their farming business. So you would tick F, yes. Then the next 2 questions are, did you make any payments that require you to file forms 1099? This would be 1099 miscellaneous, 1099 NEC. We'll talk a little bit more about those as we go to the expense side. And if the answer to that question is yes, I've made a payment in excess $600 or more to an unincorporated business, then you would want to do that. And then secondly, did you or will you file those required forms by the appropriate dates? And the answer to that is yes. If you tick no, more than likely you're going to get a love note from IRS saying, oh, by the way, we looked at your return and yes, you should have filed. And then there will be a penalty for non-compliance on that. So it's kind of self-reporting, and it is important to answer those questions. So now we're going to actually get into the form. So where we start, and we're going to look at income first. We've answered the questions about who we are and what kind of form we are, what kind of farm that we have. Now we're going to look at the first little block. And the first little block is lines 1A, B, and C. And these are going to be used to report items that are purchased and then they are subsequently resold. You might want to think about this as a way of calculating cost of goods sold. The examples may be a little bit more useful. So we've got Rob purchasing 100 feeder pigs. Now he pays $5,000 for those. And you can see that that $5,000 is reported on line 1B there on the screen. And then he raises those. And when they get to market weight, then he takes them to market and sells them. And so in this example, he sold them for $22,550, and that nets then the gross margin of $17,550, as you can see in line 1C. So the gross sales amount would be $22,550 for this specific activity within the farm. It could be an enterprise if you want to think about it in that context. The cost of which, so there's our cost of goods sold, would be $5,000. You subtract those two, and then his gross margin is going to be the $17,550. Now, some folks may use and be a seed dealer, and that's kind of what I've got illustrated here. We got Jill, she sells corn and soybean seed, and she does that because she can buy it at a discount, resell it to her neighbors, and mark it up. But the seed that she buys for her own use through this mechanism is at a lower cost. And just here you can see that the cost of her seed was $28,000. Now that would include part of her seed in that, and she'd have $35,000 of livestock of sales to her neighbors, and that would net her a $7,000 gross margin on that item. So 2 illustrations here about what happens if you buy something with the intent to raise it or to resell it down the road, and then look at the gross margin. This then gets us to line 2, and here's where probably most of the income gets reported. And this is that livestock, produce, grains, those things, fish, whatever that you are raising as part of your business operations under the business model that you're employing. I got a couple of examples here. The first one is Amal. She's growing figs and dates on her farm in California, and she sells that production under contract. And it happens to be to a co-op. She's generating her total production of $500,000, and she's going to report that as part of her total income on line 2 of Schedule F. Jerome, he's maybe more traditional in the area where I live in the state of Kansas. He grows wheat and grain sorghum. Some people might refer to it as Milo. Other people might think about it as broom corn. But as well, he has 300 head of commercial cows. He takes all of that into consideration. So he sells $150,000 worth of wheat, $250,000 of grain sorghum, $200,000 of market calves. Add all that up, and if I've done my math right, at $600,000, that $600,000 is going to be reported as gross sales on line 2. Now, Ronaldo, he's a little different. This is an example from the southeast of our country, probably longleaf pines area. And he harvests and bales pine straw for landscaping companies. And Ronaldo has several hundred acres that he rents, and he bales it, harvests it, rakes it up, bales it, and then he turns around and sells it. And he sells this, in this case, in this example, $600,000 worth of pine straw. And again, this is an annual crop. It's coming from a forest type of activity, but it is a farm activity. It's a farming product, and he's going to report that again, just like Amal and Jerome, on line 2 of Schedule F as part of his total income. Now, there are 2 cautions looking at line 2 relative to individuals that have breeding animals or dairy animals or draft animals that they raise on their own farm. Here we've got an example. Jose, he has a dairy. Now, he's a single member LLC. I throw that in there just to point out that some folks may be 100% owners of LLCs. If that's the case, it's a disregarded entity for income tax purposes, and they would report all of their income and expenses on Schedule F just as if they were a sole proprietor, but they do get limited liability protection because of the organizational structure. Now, his milking herd averages, in this case, 1,000 cows. He's got on average 600 baby to springing heifers, and he replaces anywhere from 200 to 250 milk cows per year. So basically, he's turning his herd somewhere in the neighborhood of 4 to 5 in a time span of 4 to 5 years. And his long-term average, as you can see on the screen, is $750. So he's generating anywhere from $150,000 to $187,000 and change in cull cow sales. Now, even though these animals are raised on the farm, and these are raised down, these are not reported on Schedule F, but rather they're reported on Part 1 of IRS Form 4797, which is the sale of business assets. And the reason being is the purpose for these dairy cows is to produce milk. The milk is the farm product. The cow is actually the factory that generates the milk. And so this is something where record keeping really needs to be taken place and needs to identify that these animals are not raised. We don't want to report those on line 2, even though they were raised on the farm, but they have a purpose and they need to be reported on Part 1 of 4797. Another caution is if farmers are operating in an integrated production system, either with swine or poultry, for example. And if they do that, then they're renting space, they're renting essentially their labor, if you will. And in this case, we've got Al. He does a farrow to wean operation with an integrator. He owns the barns, provides labor, utilities, and repairs. But the integrator owns the sows and owns the piglets, which the sows bear and birth. And then the integrator provides all the feed and all the veterinary supplies. And Al was paid out on a piglet delivered basis with premiums that are based on feed conversion and the number of live pigs that are born per sow. So there it goes to his skill set. Can he manage this very, very well and very efficiently? Well, he's paid every 2 weeks. And at the end of the year, he gets a 1099 NEC. That's for non-employee compensation for $425,000. Now, he doesn't own the sows or the piglets. So line 8, other income, is the place to report this, because it's in for, you want to make sure that, particularly prior to 2018, that we had something called the DPAD, which was the Domestic Production Activities Deduction, for which this wasn't going to be eligible. So it's a record-keeping issue, but also just thinking that he's providing a service. It is in agriculture, but because he does not own the sows nor the piglets, he would not report those on line 2, but rather he reports them on line 8. That gets us to lines 3A and 3B. This is where we have our 1099 patronage, or PATR. And you can see an example of that on the screen. Now, farmers and ranchers could be members of a cooperative. There could be a marketing cooperative, like a lot of dairies are, or a lot of, there's cooperatives on the West Coast for grapes, raisins, and nuts. I think Blue Diamond is a cooperative that does almonds that my wife likes. If the co-op is profitable, it's going to issue a dividend to the members based on what they have marketed with that particular cooperative. You could also be in a supply cooperative. So you buy your inputs, and it's going to be, if it's profitable, then how much business did you do on a pro rata basis? They'll calculate what your share of the total profit's going to be. And where tax preparers and farmers are going to be interested in, they want to know on boxes 1, 2, 3, and 5, they're going to be of importance. What was the patronage dividend in box 1? What were any non-patronage distributions? Per unit retained allocations could be important. What were redeemed non-qualified notices could be line 6 as well. If there's a pass-through for section 199 cap A, G, that replaced the DPAD that I talked about in just a few minutes ago. So those are just pulled. That's going to be an informational return that is received by the farmer, and they need to look at it and say, oh, this is what I did, this is what I got, this was the pass-through income, and it gets reported on line 3A and 3B. And here's just an example of that. Ralph operates a dairy, sells his milk to the cooperative. This year, the cooperative reports his patronage, and his total patronage is $1,000, but he only gets $300 in cash, and $700 is retained earnings that gives the cooperative some operation capital. And additionally, there could be some per unit retained allocations of $5,000. So in this particular example, the total amount that he's going to receive and he has to report is $6,000. But Ralph only has received $300 in cash. But you can see there that he reports $6,000 on line 3A and then on 3B. What's important to keep track of if one is a member of the cooperative is that if you get down the road, 15, 20, 25 years down the road, you may be getting some of this capital retained back, and it's going to be credited to you. And in this example, there's $5,500 that comes in. This revenue is not taxable in the current year because it was taxed in the past. And so your records need to reflect that. You need to understand what that payment is when it comes into your hands. Is this a patronage refund, or is this some capital that's being paid back? And oftentimes there's information that's being provided to the farmer and saying, this is the patronage dividend. You get the 1099 PATR, and then you could also get the statement or a letter saying, here we're getting $5,500 and it's not going to be taxable because it was taxed earlier on. Government payments come in, and these are going to be all various kinds. They could be issued by USDA, and most commonly, and we would see that boxes 6, 7, and 9 are going to be the ones that we want to look for. 6 could be a taxable grant. Now, we may want to consider that. It could be a grant that was coming from USDA for some kind of project. It could also be a grant coming from a state Department of Agriculture. Generally, all of the government payments, whether it be like ERP or MLP or whatever, those would find their way on box 7. As you can see, they're listed as agricultural payments. And there could be some, if we do some market gain, if there's some folks that are using some marketing techniques and we'll talk about whether we take loans as loans or not, or take loans as income. And when we pay that back to USDA from CCC, you might get a market gain value there. But this is also going to require record keeping, but we need to look at that. Here we've got some individuals and examples here. Louisa grows some vegetables. She markets those for local and regional restaurants. The current year, she receives an ad hoc government payment of $15,000, and this was in the pandemic recovery, and it also was to sustain her business. Her 1099-G, box 7, is going to show the $15,000 payment, and then she needs to report that, as you can see illustrated here on 4A and 4B, that $15,000. And so another one is Richard. He has a traditional farm, corn and beans. He has $20,000 of risk coverage payments, $10,000 in cost share payments, conservation project of $25,000 on his farm, as well as $25,000 in market facilitation payments, or the MFP payments. And lastly, there was some conservation reserve program payments that he received for taking some highly erodible land out of row crop production. And so when you look at his 1099-G, there's going to be a box 7. It says $70,000. All of that's going to be subject to tax in the current year and be reported on 4A and 4B. As I mentioned a moment ago, farmers do have the option to make an election. It's under Code Section 77 to treat CCC loans as income. Now, typically, loans are not taxable. You go to the bank, you borrow $100,000, for example, that's not going to be taxable income to you. However, when you start paying that back, those principal payments are not deductible, and you're going to be making those principal payments with taxable income. So that's a general principle of accounting, but you can make that election, and this could be revoked on an annual basis. So it's a tool to manage farm income, and I give the revenue procedure is listed there on the screen. In this case, we've got George and his tax preparer. They worked together. They looked at, for the current year, making the election to treat his $100,000 CCC loan as income is going to be a good option relative to his long-run business goals. So you see box 5A is going to say reported under the election, $100,000. But what happens down the road when we repay that? Well, here, remember, we had the cost of that because we reported it $100,000, but because the commodity price increased, and you might recall, for those that may be growing corn, that in 2021, that we had some $4, $4.50, $5, and then it started bumping up to $6 corn towards the end of 2021. And then into early 2022, we actually had some $8 corn. So all of a sudden we had that scenario, and guess what George decides to do? He made the election, he reported that income. Now he pays that loan back, but what he needs to do is he doesn't want to pay tax on that corn twice. So you see that on line 1A, he's going to have the $200,000. He has that $100,000 of corn that he elected to treat as income. That now becomes his basis in that commodity, because remember, he paid tax on it last year. And now 1C, he comes in and he's got that net $100,000. And we need to clearly communicate this if we're using a preparer to avoid double taxing that $100,000 that you see issued on line 1B. Now, if we treat loans as loans, then there may be an opportunity if at harvest, it looks better to just say, hey, you know what, we're just going to let her go. So we may treat it as loans forfeited. And so we forfeit those loans. The price has dropped $150,000 because we treated it as a loan. Now we have to report it as $150,000 and we carry that over. And so this could be an example, as you can see here, if we read it. And I know that it may be kind of like drinking through a fire hose, but just think about it, that in the economic sense, it didn't make sense because the local corn price was below or under her loan value. And sometimes that happens. I remember when I was farming in the 1980s, that was not an uncommon event across years. And so she may forfeit those and then go ahead and report those. And it's just an illustration that you would do that on 5B and 5C. And if we do it at the posted county price, here we've got Jerome again, $150,000, doesn't make the election to treat the loan as income. County price is $325,000. He repays the loan with $135,000 and then turns around and sells the corn for $145,000. Well, how do we balance that out? Well, we have $145,000 that's going to be treated as the sale. He had received $15,000 in difference. And so his total income, when you look at that and you see the math, it's going to be $160,000. He got the 150, he pays it back. So he's kind of having a little bit of a market advantage then. And then he turns around and sells that corn for $145. But he gets that CCC 1099G for $15,000 because they know about the 150, and they have the 135. So he's got to report the difference in that regard, as you can see there on the screen. And again, record keeping and clear communication with the tax preparer is necessary. Moving to line 6, we've got 6A, B, C, and D. This is for our crop insurance and our disaster payments. Broadly, we've got to be aware of the constructive receipt rules. When you receive it, that's going to be when that income is going to be taxable, but there is an opportunity to defer those payments if the farmer sells 50% or more of their crop production in the year following when it was actually grown. So if I grew it in 2022 and I could defer to 2023. So it's very important, again, to understand the business model that you're trying to farm. And the examples, I think, will help illustrate this. So here, our friend Roberto, he's got wheat, corn, and beans. In 22, hailstorm ruined the crop. He experiences a 75% reduction in yield, sells the wheat a few months after harvest anyway. He receives a crop insurance check for the hail damage of $50,000. He receives a 1099 miscellaneous from the insurance company, $50,000, because his business practice was to do it in the same year. He reports it 6A and 6B. But if the insurance company didn't issue the check until the following year, that's when he's going to report it. You can't accelerate income back into the year by reporting it. And here's where I'm looking at the example, if his business practice was to sell the wheat crop in the year after it was produced, he can make that election to defer that crop insurance. Same $50,000, he's going to report it on line 6A because he does have that 1099 miscellaneous he has to deal with. And he needs to report that. Otherwise, he's going to get some communication from IRS saying, hey, we have a 1099 of $50,000. We don't see it reported on your return. And if it's crop insurance, they're going to be looking at 6A or 6B. Notice that box C is ticked, that we made the election to defer, and we tick it right there. And then subsequently, if we bring that income forward here, just another example, here we have Amanda, and what she's done is she's deferred into 2022 the amount from 2021, and she's just picking that up in her 2022 return of $350,000, and she would just report that on line 6D. So last year's return would have looked like the previous slide that Roberto had. This year's return, 2022, in this particular example, is going to be reported on 6D as in Delta, and then everybody would be clear with what she's done. And I know that I'm going fast, but I know that you're also going to be able to get these slides and you can review and read those examples, and it may make it a little bit easier. Custom hire. So as I said earlier, sometimes farmers are going to help their neighbors. Here's the case of Ted. He helps his elderly neighbor, Tom. Tom pays him for his work, and he pays him $1,200. Tom issues him a 1099 NEC, non-employee comp, for the $1,200. Ted's going to report that on his Schedule F. He doesn't do this all the time, and he's just being a nice neighborly fellow. So he puts it on line 7, as you can see there, for his machine work, $1,200. Looking at the model, and there's a couple of other examples here, Georgia and Jose, both of them may be machine hire. The one that I would want to look at is that Jose manages and operates the poultry farm, but his custom work from digging foundations is $200,000. The one thing you might want to pull away from this is that it may be that he farms part-time and he actually has a backhoe business. So again, looking at the facts and circumstances, just because he has a poultry farm may not mean that we want to report all of that on Schedule F. It may be better to split it out and have a Schedule F for the poultry business and then have a Schedule C for the custom work digging foundations. Line 8, as we're moving through, is the catch-all. It's the miscellaneous. It's where we have bartering income. Yes, bartering and the income and services provided are going to be subject to income tax at fair market value. Could be state gasoline or fuel tax refunds received, federal fuel tax credit, breeding fees, occasional fees from renting draft teams or farm machinery, perhaps. They would be other income that you might want to report. Here's just an example of looking at that. Bill buys 500 gallons of gas. He's burned it through his 2 gas tractors. The federal excise tax that he claimed on his 2021 return is going to be filed in March of 2022. So it's $92. I got that by the federal excise tax of 0.184 per gallon times 500. And so he's going to report that as other income on his Schedule F in the following year. That gets us to line 9, which is just the summary. You just add everything that on lines 1 through 8. And as you can see in this particular example, Jorge has got $329,200. If I've done my math correctly on this. Now, if 2/3 of his gross income, and we're going to look at line 9 for that, if he meets that, then he's going to be deemed as a farmer for the purposes of not having to make estimated income taxes. But he would file his tax return by March 1st. The other thing that we need to look at is that if he has any conservation expenses, those are going to be limited to 25% of what's on line 9. So 25% in Jorge's case is going to be $82,300, as you can see here. So that would be the maximum that he could deduct in this particular year for those if he had. So that wraps up income. And I'm looking at the time. I think I'm going to be able to do this so that we'll have a little bit of time left over. And I see there's some questions that are popping up. Now what I want to do is change horses. And I want to go to farm expenses. I want to look at what do we need to think. And there's going to be some planning pointers to think about as we go through those. The first one, so now we're on part 2 of Schedule F. Part 1 is the income side. Part 2 is the expense side. So part 2 begins with line 10. And it's where we report the expenses of cars and light trucks that are used in the farming business. Now we have a choice. We can use the actual business expenses and we need to have records that would substantiate those expenses, or we could use the standard mileage rate, which for this year, 2023, is looking at 65.5 cents per mile. And just note, of that, 27% is $27, 27 cents of that is going to be the depreciation component of that 67. So basically, if you look at that, 40 cents is going to cover gas, oil changes, tires, and other of those kind of things. Mileage logs are going to be required. Now, there is a temporary Treasury regulation that allows farmers and farmers only to deduct 75% of their auto and truck expenses without records. So you can just tally it up. All you would really need to know is how many miles, what was the odometer on January 1? What was the odometer on December 31st? And you figure out what the total miles are, and then you take 75% of that. Here's an example where we look at that. We got Jeremy, he's got a 3/4 ton pickup. He uses it both for personal and business. Now he keeps a mileage log separating those two, and it ends up being that 75% of the miles were business miles. So he could have saved himself some heartache, but at the end of the day, he's got 75% of all those actual expenses, and he would deduct those on line 10. He would also have the depreciation reflected on line 14. And in the lower left of this particular slide, we just show that he had total miles. Of those, 30,000 miles were business miles that he drove this year. So that gives us our 75%. We've got our annual fuel costs of $7,600. We've got repairs of 15. As you can see there, total costs are going to be $20,870. But the allowable business is going to be at 75%. So we have to make that calculation all the way through. And so you can see that we will report the depreciation portion on line 14. There's our 8640, and then the balance to get our 15,652. That's going to be our $713 that you can see on line 10 of this particular example. Now, Jeremy, if he wants to, he does purchase another truck. He wants to simplify a little bit, and he decides to use on this particular vehicle the standard mileage rate. Now, he keeps the mileage log. He can document that he drove 22,500 miles. He also paid $150 in tolls that were for business purposes throughout the year. And so he has a total to report of $14,880 as his automobile expense. And you get that by 22,500 times the 65.5 cents per mile. This is for 2023. And then you would add to that the $150 for the tolls. That gives us our $14,880, and voila, you're done. It's there on line 10. Now, several lines on Schedule F are relatively what I would refer to as self-explanatory, and they're listed here for you on this slide. They're chemicals, freight and trucking, gas, fuel, oil, seeds, plants, storage, warehousing, supplies, etc. Those are relatively straightforward. The record-keeping system would delineate those, and you just add those totals and you just report them. And here's just the illustrated self-explanatory lines. We're looking at, again, part 2. Here's our expenses. And so in this example, we got $40,000 worth of chemicals. We got $750 in freight and trucking. You've got some veterinary, breeding, and medicine expenses for the livestock over on line 31, $12,400. And then the seeds, $35,000. As you can see, y'all can read just as well as I can, but you can see that, yeah, this makes sense. These go to this place, and they are the self-explanatory. Now we get into one that's a little bit more, we need to be more careful, and we need to be understanding what the tax rules are telling us. And this is going to be our conservation expenses. So conservation expenses are going to be those that are going to be, number one, part of a conservation plan, which is going to have been approved by NRCS or a state department for environment or whatever may be the local in the state. And again, it's going to be subject to the 25% of gross farm income limitation, which I spoke to and illustrated to just a few moments ago. This is actually where we need to look at. This is under Code Section 175 in the Internal Revenue Code. And it's very explicit as to what are going to be soil conservation expenditures that are going to be allowed and that are going to be limited for this particular purpose. You can see those, they're listed here. I just kind of pulled it straight out of the code and cleaned it up just a little bit. Earth moving for leveling, grading, terracing, construction of diversion channels, any drainage ditches, irrigation ditches, ponds, waterway outlets, etc. Eradication of brush. Now, this is for the recovery of pasture or field borders. These have already been used. This is not clearing land. Clearing land goes to the basis in the land. It's not a deductible expense. So this is the eradication, and that's why I have that parenthetical. It's the recovery of pasture or field borders. Planting of windbreaks, and then the last one is anything that is site-specific management that needs to include because of the Endangered Species Act of 1973. Those are going to be those allowed on line 12. Now, we also might have some stuff under EQIP or under WHIP that come under a different program, but are also tied with conservation. But you need to watch out for these and think about if you're expending these kind of expenditures, they're going to be limited to 25% of gross farm income. And just here's an example. Reggie lives in the Low Country, implements soil and water plan. Now he receives $65,000 in cost share, but he spends $92,000. So due to the 25% limitation, he's only going to be able to deduct $81,250 because, as you can see, his line 9 is $325,000. So 25% of that is going to be $81,250. So what do you do with the difference? Well, the difference, that $10,750, is carried forward until it is consumed. But each year you still have to watch out for that 25% rule because there could be some other soil and water conservation expenditures in those subsequent years. But that's how this works and how the rules and allowing that tax deduction on the tax return. Custom hire. So here's where we are paying for custom hire. In my example here is going to be Sydney hires a custom harvest crew to combine her wheat crop. She pays them $25,000. Now they are not incorporated. So Sydney has to issue them a 1099 NEC for non-employee comp. You can see it listed there on line 13. That's why it's so important when, as we looked at the first part, you tick those two questions. Did you make payments that require yes or no? And in this case, Sydney would have had to tick yes. And then because IRS is going to be looking at this through their systems, and then did you indeed issue the 1099? Depreciation, this is a topic that we could probably spend 8 hours on. I'm just going to hit it very, very quickly though. But depreciation is reporting the recovery of depreciable asset costs. There's several different ways, and that we can use this to manage the number, and I've got the number in quotations, looking at those to say, hey, what is the amount of tax or what is the amount of profit that I'm targeting? We've got bonus depreciation, which prior to 2023 was 100%. It was the presumption of law. This year in 2020, we're looking at 80% of those eligible assets. We have the expense selection. It's section 179, and that goes up to a little bit over $1 million. We have makers, general depreciation system. So for agricultural assets, they're going to fall into the 3, 5, 7, 10, 15, or 20-year recovery periods. And makers ADS, that's the alternate depreciation system, that can be used to lengthen recovery periods if we're just getting started up. And we use a separate form, form 4562, to go ahead and make that calculation of what that annual depreciation deduction looks like. In this particular example for line 14, we see George. He operates a diversified crop farm. This year, 2022, he purchases a new tractor for $175,000. He has $85,000 of depreciation, which is allowable on those assets that were purchased prior to 2022. And so he assumes he doesn't elect out of the bonus depreciation. He's going to have $260,000. You add 175, 185. So he just pops that in there, $260,000. Now, he would have the same outcome if he elected to expense the tractor, but bonus is presumed under the law. You have to elect out of using bonus, where you elect into using Section 179. Here's another example, just looking at tax planning. Here we have Maria. Now, Maria constructs a new greenhouse for her cut flower business. It's $85,000 is what it's cost. Now, it's a special single-purpose structure for horticultural activities, growing of cut flowers. It has a 10-year recovery period under the statute, but Maria says, you know, my business is growing. I want to defer that depreciation until I start having more income. So I'm going to use the alternate life of 15 years. That's going to require using straight line depreciation. And when that happens, the greenhouse no longer qualifies for bonus. And she makes that election just simply on Form 4562, as I've illustrated here. $85,000 under 15-year property, and half years straight line. $2,833 is what this year is allowed. She's got $24,000 of depreciation coming from assets that she's purchased in prior years. So what she's going to report on line 14 of her Schedule F is $26,833, as you can see calculated there, which is coming from line 22 of this form, which is Form 4562. Something that, excuse me, probably isn't very common, but it could be, and that is looking at employee benefit programs. And just in this example, we've got some daycare facility for the employee, and a mall contributes $200 per month for the employee. She has 5 employees that participated. As you can see, do the math. In this case, she's got $10,000 that she's going to deduct as an employee benefit program. Again, probably not very common for farm operations. Another one here is health insurance. Likewise, it can be purchased, and in this, my example here, she's getting it through the National Fruit Packers Association, and again, providing some of her employees health insurance coverage at the tune of $85,000. Feed expenses. Here we've got for farmers and ranchers, they purchase feed, vitamins, minerals for their livestock. This is all going to be deducted on line 16. And in this case, you can see in the example, we've got Robert. He's got these calves. He needs some creep feed. He's got some stuff that he wants for the moms. He spends $20,000 on all of these items. It goes in on line 16 on Schedule F. Now, there is a difference because sometimes at the end of the year, we may want to take advantage of end of year sales, but you need to be very careful. And this example illustrates why. We've got Everett raising hogs. On November 1st, he issues a check for 10 grand to Tasty Livestock Feeds. Now, he does that on his account, and he can make draws, and he picks up the feed on a weekly basis. And the weekly feed price is going to be determined by market conditions. So if he picks up the same amount, it could be that's going to be a different price each week. In this particular example, the payment is a deposit. It's not going to be allowed as a deduction in full. However, he's going to be allowed a current deduction for those weekly feed purchases from November through December based on the receipts and the respective draws for those particular weeks. And that is something to be very much aware of. Fertilizers and lime come next. This is on line 17. So any of those soil amendments, we're going to be able to take those as an deduction. Now, under Code Section 180, they're technically supposed to be amortized over the useful period. However, commonly, annual elections are made to deduct those by just simply reporting them on Schedule F, line 17. And most folks, that's what they do. They may not know that they're actually making an annual election. So here, Bonnie raises eggplant and squash. She regularly conducts soil fertility tests, follows advice. This year, she's applied $35,000 of fertilizer and lime to her fields, and she chooses to currently deduct these by making the 180 election. And simply, you make that election by putting it on line 17, just as illustrated here on the form in this example, and you deduct the $35,000. However, you want to be aware that this is a planning tool. Now, Jacob, in this case, he typically spends $100,000 on fertilizer and lime, but this year he's had some bad weather. He's had a farm loss, and he really doesn't want to show a loss. So what can he do? Well, in this case, what he does is he doesn't make the election, but he follows 180, capitalizes, and takes that expense over 5 years, and then deducts $20,000 this year, and then defers the $80,000 to be taken ratably over the next 4 years. And in this case, he didn't take in any more money, but he increased his farm income by $80,000, which is the deferred expense. And thus he doesn't have a farm loss, which may give him access to other tax benefits, such as the earned income tax credit, where he might not lose the full benefit of the standard deduction based on his filing status. And here's just an example of the amortization table. You've got $20,000 taken in each year, the remaining amount as you can go through there, and then he has $0. Lines 21A and B is where we deduct our interest. Now, farming is capital intensive. Many operations borrow money, and they do that. Line 21A is used to report interest from mortgages, where the farmer is reported to have paid that interest on a 1098 mortgage interest statement. Line 21B is for interest from other sources. So here we've got Frida, farm, along with farm credit on some farmland. She's paid $25,000 in interest, and it was issued to her on a 1098. It matches to what is in the records, so we would report that expense on line 21A. Ken operates a diversified farm. He pays $15,000 interest on his operating loan, $5,500 on his pickup, and $27,000 on machinery and cattle loans. Now, none of these loans report the interest on a 1098, but they're still business loans. And he's able to use 21B to report $47,500 of interest. IRS is going to match what's on 21A versus what's on 21B. If inadvertently Ken had reported on 47.5 on 21A and did not receive a 1098, probably would get some correspondence from IRS trying to explain that. So that's why we've got the two lines, 21A and 21B. Here we've got Rosita. She's got a large vegetable cut flower business. Now, what she's done with her lender is she's prepaid 3 years of projected interest expense at a locked-in rate. And with the environment that we are, because today the Fed did increase interest rates by another 25 basis points. So we are in an interest increasing environment. Well, in this case, she pays $45,000 of interest, but $8,000 of that is allocable to her in the current year. That's what she's going to be able to deduct on line 21B. The remaining $37,000 is going to be credited to her account as prepaid, and the bank is going to draft that quarterly over the next 3 years. So this year, because of the tax rule relative to interest and also rent and also insurance, if it is there is some benefit that is greater than a 12-month period, you can only take that which is within the current tax year. And in this illustration, it's $8,000 on the interest side. Now, here's an option that farmers have available to them, and that is if you've got your home paid off and you want to expand the farming operation, in this case, he wants to go full-time, he could borrow $200,000 against his house, which provides him with funds to purchase the equipment and give him some operating money. And this year, his interest expense is $6,000. Now, he is going to get a Form 1098. Now, does he treat that as homeowner interest or does he treat that as business interest? In this case, it's going to be in his benefit to make the election to treat this interest as business interest and deduct it on Schedule F. Thus, it not only is a deduction against income tax, but it's also going to be a deduction against self-employment tax. And so the $6,000 in this case is going to be deducted on line 21A on Schedule F. And you would need to have documentation for that particular deduction. Labor kind of goes without saying. If you have labor expenses, you would hire two employees in this case, and he pays them $30,000 in cash wages. He reports and deducts $60,000 on line 22. However, if you get some opportunity to get a credit as part of an inducement to get employees, and in this case, we've got Carla, she has them, she's able to claim the work opportunity credit, and she also gets another credit, the employer credit for paid family and medical leave that she gets, so a total of $5,000. She's going to have to reduce that $50,000 by the 5. In other words, IRS doesn't want her to get a double goodie, if you want to think about it in that way. So you'd have to make that adjustment on line 22 and report the 45 as illustrated in this particular example. Pensions and profit sharing, we're now sliding over and coming through. Some farms may do that. Again, not very common, but I just wanted to illustrate it since we're doing line by line. Here we've got a dairy farm, and they have retirement opportunities and participation. He contributes up to $3,000 per employee. And this particular year, $25,000 was contributed for all of the participating employees. And so you would see that on line 23. There's the $25,000 for those employees that Jim, the employer, made on their behalf. Rents, lines 24A and 24B, another split line where we've got a couple of more things to think about. Farmers and ranchers are going to rent land. Typically, in my experience, they're renting 2 to 3 acres for every 1 acre that they own. They use that rented land to help pay for the land that they've purchased. But they may lease equipment. They may also lease breeding animals. It just depends on how they're going to grow their business. And those rental payments are deducted on lines 24A or 24B, depending on what the asset is. In this example here, we've got Antonin. He farms 1,500 acres, 1,000 acres from 3 different landlords, and he has 500 acres of owned property. Now he pays an average of $235 an acre of cash rent. This would probably be somewhere in Iowa or Illinois, for example. At that price, he reports $235,000 in land rents. Now he's got 3 landlords, so he's going to issue a 1099 miscellaneous and put the amount in the rent box of the 1099 miscellaneous, $100,000 for one, and then he's going to have 2 $67,500 1099s for landlord 2 and landlord 3. IRS is going to match the rental 1099s with his return and also those with his landlord, but he's going to report that on line 24B, as you can see there on the screen, the full $235,000. Isabella rents a machine. Now this is, a short-time lease. She needs a backhoe, digs out a water line. Her employee, Roberto, operates that machine. It's $75 an hour. So the hour meter showed that she had used it for 10 hours. So the total amount is $750. And so it's going to be on line 24A in this particular case to report and deduct that rent. Now, if ABC Inc., and it is incorporated, there's no need to issue a 1099 miscellaneous under the rules. So she doesn't have to do that. But if they were unincorporated, then yes, they would have to do that. Here, looking at a planning strategy, renting of land and machinery together. So Grandpa Joe rents his farm and equipment to his granddaughter Emily, and then the land and equipment are rented together as she's a beginning farmer and needs the equipment to operate. And Grandpa Joe wants his land to be taken care of in a certain way, and he wants to make sure that the machinery and equipment's available to do it. So they negotiate that, and it's going to be $65,000 as a total package for land and equipment, $40,000 for the land, $25,000 for the equipment. And so you can see that split. It's going to be there, 24A and 24B. That's how Emily would report it. And again, she's going to tick the questions to F and G in the affirmative that we talked about at the very beginning of this presentation. There's a couple of other examples here. I'm going to leave these for your own reading when you get to look at those, but it deals with looking at, is it an operational lease or is it a capital lease? And we do need to be careful about that, but just I think if you would read these two examples, it would be helpful to you to understand the difference between an operating lease and a capital lease. And I want to get to repairs and maintenance, being sensitive to the time as well. Repairs in and of themselves, they can be a pretty big item in the relative, regardless of scale. Repairs are costly, and if they are, then you need to think about, should they be capitalized? And what IRS looks at is, does this expense lead to a betterment or an improvement of the asset? And if so, then the cost needs to be capitalized. Is the expense a restoration of the asset to continue in service? Then too, it's going to be required to be capitalized. Or does it adapt? Does this expense adapt or change the use or the purpose of the asset? And if so, then the cost needs to be capitalized. The proper way would be, yeah, we recognize it, but we have also Section 179, we have bonus depreciation that oftentimes will allow us to take that off as a repair, so as a depreciated item. So we would not put it under repairs, we put it on depreciation, but we still get the tax benefit of taking the entire deduction in that current tax year. But just be aware that it may look like a repair, but we need to think about it. Here's just an example. Bob's performing the routine maintenance on tractors, combines, and trucks, and he spends $10,000 on oil, antifreeze, hydraulic oil, and filter changes, and it's reported as a repair and maintenance expense. No question that that is maintenance. Here's another example that we need to think about a little bit. Armando purchases an old set of grain bins and scales. Now, these are adjacent to his farm, but he has to do some repairs. He's got to put new flighting in the augers. He's got to put new dampers on the scales so that trucks won't override the weighing arms. And he's going to spend a total of $45,000 to bring these bins and scales back into service. And this is an example of restoration before the units can be placed into service. That's why I have that highlighted. And therefore, these $45,000 could be capitalized, added to basis of the grain bins and the scales. Now, you can make the decision on depreciation. Do I take bonus? Do I do Section 179? Do I depreciate? What's going on? But we don't want to just write off $45,000 in this example as a repair, because this was spent to put it into service. Now here we've got another one where we need to think about it. Theodore operates a farm. He spends 25 grand on replacing an engine to return this 5-year-old tractor to service. Now, two arguments could be made. Number one, this is a repair. It occurred just outside of the manufacturer's warranty, but before the tractor was fully depreciated over a 7-year recovery period. The value of the tractor, $150,000, wasn't greatly enhanced. And if you look at it, so it could be a repair. Now, a conservative position was, it's to recognize that this might be a betterment. What was the tractor shape really like prior to the use? And maybe we want to capitalize it, and then we could use bonus depreciation to recover the cost. Same thing as what we've talked about, is that we want to take that 100% bonus, which actually ceased on December 31, 2022. We're now at 80%, still same type of principle that we want to look at. But planning technique, planning strategy, as well to utilize the tax laws correctly instead of maybe if a return is going to be audited, having to explain. Line 29 is we're coming into the closing part and finishing up this particular form. This is going to be for taxes that are part of the business items that are going to be there. So Social Security and medical taxes, Medicare taxes that the farmer or rancher pays to match the withholdings from employees' wages is going to be reported on line 29. If there's any federal unemployment tax, if the farm is sufficiently large enough and pays sufficiently large wages, then you need to have federal unemployment. Federal highway use tax on heavy duty trucks. This is where you're going to report it and take the deduction. Any state unemployment fund contributions under state law, if required, it's going to be treated as a tax. Property tax on farmland used in the trade or business, and property tax on farm machinery, livestock, and vehicles, if those items are subject in your state to property taxes. This is where we would have those items that are business related and reported together in total, and then we take that as a deduction. So here's an example. You've got Louisa, she's got an employee, she matches the withholdings. This year's $7,500. She also pays $8,500 in real estate property tax and $3,500 on our farm machinery and farm vehicles. So the total of that's $19,500, and that's where you see it on line 29 on the taxes in this particular case. Taxes that are not a business deduction. This would be federal income taxes and include self-employment for the farmer and the rancher. The farmer or rancher may deduct half of their self-employment tax, but that's going to be on Schedule 1 of 1040. Property taxes on the principal residence and personal property not used in the business. It could be that these are going to be eligible as an itemized deduction on Schedule A, Form 1040, but these are personal assets. These are not business assets. And any taxes assessed for improvements such as road or sewers in the locality of the farmer's residence. And typically these are going to be added to the basis of the property if that happens. State and local sales taxes on items purchased for the farming business. These are going to be added to the cost of the property. And then if depreciated or depreciable, then they're going to be taken over time, or using bonus depreciation, you go ahead and take them in the first year. And then any other taxes not related to the farming business. Utilities. So now we're getting line 30 here, farmers, ranchers, they've got various utility expenses. So the example I have that Billy operates a farm has a landline that goes to his farm home and he shares with his wife. The base rate's $15 a month. So his average phone bill is $150 a month, of which $75 are business calls. So he can deduct $900 at 75 times 12 of his phone bill. He's not going to be able to deduct that $15 baseline because that is specific in the code. So in this example, there's going to be his $900 on line 30. Now, if we've got split things looking at, and we kind of had that earlier illustration looking at the phone, but now you got electricity or you got water, how this all comes in this particular example, we've got this running through. Now they estimate that they spend $100 a month for personal electricity, $75 a month for water that goes to the house, but the remaining balance over these allocations is going to be for farm utilities paid for farming, and that's going to be deductible. So this year they paid $6,000 for electricity, $4,500 for water. So $4,800 of the electric bill is for the farm business. So that's $6,000 minus the $1,200. $3,600 is for watering livestock. That's the $4,500 minus the $900 for personal. So now you add those two numbers together, you should get $8,400. That's going to be the allowable farm utility expense that we find on line 30 on Schedule F. And it's just illustrated there again at the bottom of the screen. So what about other expenses? Well, there's a whole mess, and this is kind of You know, we had other farm income that was kind of at line 8 at the top. Well, this is line 32, lines A through F that we have here. And these are going to be farmer identified business costs. It could be professional fees for accounting or legal work or payroll services. Could be $150 for office supplies or whatever. And here you just illustrate those. I've got those there for you. The one thing is there is if you've got a home office and you use it exclusively for the farm business, then you might want to think about taking the $5 per square foot safe harbor. In this particular case, he's got a 200 square foot office. So he's taking $1,000 as his home office deduction. And you just list that there on line, in this particular example, line 32C. If we have startup expenses, we're beginning our farm. And in this case, the mom's beginning a pick your own berry farm. She inherits the land from her parents, which had mature berries plants on it, but it's a new business to her. She needs to calculate the startup costs. She spent $20,000 in an allocable startup, $5,000 of which under current law, she can deduct in the present year, but the rest, the remaining $15,000, she has to amortize over 180 months, which would be $83.33 a month, if my math is right. So the total startup expense that's going to be allowed as a deduction this year is going to be $6,000, and that you can see illustrated on line 32A. Then the remaining 14 years, she's just going to annually deduct that $1,000 as remaining startup costs. So the record system needs to be such that either there's a note made or something that we don't forget to take that $1,000 of remaining startup expenses going forward. So wrapping up, we now have line 33. It's the summation of all of these expenses, lines 10 through 32F. And in this particular example, Georgia's got $652,435 total allowable farm expenses that she used with her peach orchard, and she reports that total on line 33. What happens? And then you just get the net profit or the loss. That's going to be on line 34. So in this case, we've got Alfredo. He's got $895,345 gross income. This is coming from line 9. Which is the last line number on part 1, as you might recall. And he reports $767,562 of total expenses on line 33, as you can see illustrated here. That gives him a net profit after all expenses of $127,783. And again, scale doesn't matter per se. I'm just illustrating this with just some numbers just to see where they all fly through. The one thing we do have to be aware of is what happens if we have a farm loss. Now, in this particular case, we've got Susanna. Her fruit orchard generates a farm loss because of a freeze. She ends up having a loss of $135,891. This then requires that she has to answer the at-risk rules that you see on line 36 at the bottom. You got to check the box that describes the investment in this activity. Is all the investment at risk? So meaning, are they recourse loans or are there non-recourse loans? And if they are non-recourse loans, then some of that investment may not be at risk. So we need to think through that question and say, are they all recourse? But if we have a loss, we've got to answer that line 36, that are we at risk? If we are, then we can take all the deduction. If we're not at risk, we may then be limited to how much of that loss we're going to be able to take if we've got other income that might be reported on the income tax return. So the summary of all of this as we're wrapping up, and looks like we've got this, is that cash basis is going to be complete when the following appropriately enumerated and are prepared to be filed. The responses and details are reported in the information block at the first, and we're going to answer questions A through G. Then part 1, we're going to look at farm income. Has it been correctly and accurately reported on lines 1A through line 8? And then do we have the correct number of gross farm income calculated on line 9? And then the allowable farm expenses are accurately and correctly reported on lines 10 through 32F. And we talked about some of the elections that are available. We also talked about some of the limitations to the deduction, such as soil and water conservation being limited to 25% of farm income. So we need to think about all of those things. And then finally, the total expenses when they are tabulated on line 33, does that create or does that help us derive a net farm profit or loss? That we report on line 34, as we just saw just a moment or two ago. And then if there's a loss, then we have to answer the applicable question on line 36. So that gets us to, that was pretty quick and dirty. We went through that in about 80 minutes. So we've got some questions. I'm going to stop sharing my screen. And I'm going to go full screen. Q&A. All right, let's see. I'll be selling the development rights to my farm this year. Can I use farm income averaging to offset this income? No, because that is a land interest, and that does not come from farm production. Issues with reporting activities on Schedule F that may not be proper. I'm not sure what that means. If it's not a farming activity, you should go to Schedule C. So, for example, if you raise apples, but your product is apple cider, you're selling apple cider or apple pies, then the raising of the apples is a farm activity, and then there would be a transfer of apples to the processing activity where you make apple cider or apple pies. The cidery and the pie manufacturing would be Schedule C. Is maple syrup considered farming? Yes. The selling of eggs? Yes. Are single member pass-through LLC farms? Yes, they are. Single member, a Schedule F is a pass-through business entity that goes to the sole proprietor. Single member LLC is a disregarded entity, as I mentioned before, and you would go ahead and report it on Schedule F, and it just passes through to the proprietor's income tax return. I am a small one-person farmer. Would I want Schedule F rather than Schedule C? Yes, because Schedule F, as we've talked about this afternoon, is for farming activities. Schedule C is for non-farming. How would spending approximately $250,000 on a large barn and also farming equipment and drilling, seed, and fertilizer for producing hay? The barn, if it's a multi-purpose barn, you recover that by depreciation. The farming equipment, depending on whether it's used or new equipment is depreciated over 5 years. Used equipment is depreciated over 7 years. Drilling, seed, and fertilizer and such is going to be an operating expense. And we kind of talked about those as we go through. I'm not real sure what the real question is behind that. Spending 250 grand just to look at hay. Hay is a low value crop unless it's alfalfa and you're selling it to racehorses where you can get a premium, but you want to make sure you don't get blister beetles in that because you don't want to have to pay for a dead racehorse. What if your crops and activities are split, say timber and part row crop, part dairy? Okay, so timber, you could be in the business of being a tree farmer. You would be a farmer for row crop and you would be a dairy farmer. So they could all be reported on Schedule F. Timber is a little bit special. There are a couple of elections specific to timber. I don't have the time to go into that. Or if your intent is that timber is a long-term investment, it would receive, when sold, it would receive generally capital gain type treatment, but the row crop and the dairy, that would be could be on one Schedule F. My husband and I farm together. Our taxes are filed together. Does it matter whose name we use on the proprietor since there isn't space to enter both of us? No, just be consistent one year to the other. The other option that you have is if you want to do that because your husband and your wife there, what you could do is do a qualified joint venture and just split the Schedule F in half. And each of you report half of the income and half of the expenses on two Schedule Fs. One's going to be in his name, one's going to be in her name. They come together on the tax return and it gets treated. But that way, each individual generates his or her own Social Security accounts. Would the cost of dirt, seed, and containers for plant starts count as a cost I paid? Or is it site specific to seed only? No, yes, that would go under planting. That would go under the containers, probably would be supplies. The dirt, you could, if you wanted to keep separate, you might put that on 32. That could be, potting soil, etc. Could we count our time under there if we were selling raw vegetables? I'm not sure. Sole proprietors cannot pay themselves wages. They take draws, and then you look at the end of the day how those costs were. Did you make a profit or not? With the sale of value-added products we make on the farm using a raw product that would say be reported on line 1 or 2? No. Value-added products are a Schedule C business, just like I said, cheese or apple pies. You would transfer the raw product from the farm to the Schedule C business. What did 1099 NEC stand for? It stands for non-employee compensation. So if you, for example, I'm unincorporated and I'm a repair person that comes out and I fix the heater in your shed for your chickens, and you pay me $600 or more, you're required to issue me a 1099 NEC for that work. Is there any good listing of accountants familiar with Schedule Fs listed by state? Not that I'm aware of. Would CRP payments be reported on line 7, cause of self-employment tax? CRP payments are a government payment, so they're going to be reported on the government payment line. But if you are if the recipient of the CRP payment is receiving Social Security benefits, then you would make the subtraction on Schedule SE, and thus it would escape self-employment tax. But generally, if you are receiving CRP payments, they are going to be subject to SE tax. I bought a high tunnel greenhouse in 2022 for $16,000, put it up for $6,000, received a taxable grant of $4,000, but didn't produce anything in 2022. Should I report this in 2022 or 2023? Okay, so you're going to have to report the $4,000 worth of income because you got the 1099-G. I'm assuming that the greenhouse was ready and available for service in November when up. If it was, then its depreciable life starts then in November. It may be that triggers mid-quarter convention, and so you would get very little depreciation in 2022, but then as you start producing in 2023 and going forward, you would get most of that in depreciation in those subsequent years. If you don't have much farm income, that's probably the line that I would go. And it depends on if you've got some off-farm income, there's a whole lot of things that go on, but just reacting to what you've written there, it's going to be, I would suggest taking it in subsequent years. Will you cover adding value and reporting on Schedule C? No, this was a farm thing, not for schedule. That would be another webinar. Sorry. Should I report labor expenses even though I didn't issue a 1099 SCC? Labor expenses should be under wages, and they should get, or labor is reported generally with a W-2 for employees. The 1099 NEC is used for independent contractors. I meant to say line 4A. Not sure what that's referring to, but I hope I answered it. Support for the 75% rule for auto expenses. It's a temporary Treasury regulation. I don't know it off the top of my head, but there are several places. I think it's on ruraltax.org talks about it. There's a depreciation worksheet there. There's also the CALT website at Iowa State University has it. So, but it is a temporary Treasury regulation that was issued about 35 years ago. Does the car or truck need to be owned by the farming entity to take the car or truck expenses? If the entity is an LLC, yes, it should be there. Otherwise, you're using a personal vehicle, and then you're going to should be reimbursed by the entity for its use. So, and if you're going to be using that for farming business, you want it titled in the LLC, because if something happens, if there's an accident, you want to be covered by the limited liability protection, and you want to make sure you have sufficient insurance also to cover it. Is hiring, whoops, okay. Does I-10 work for filing Schedule F in the case the individual has no social security number? It's better than nothing, but the I-10 could, if they're self-employed, if that's the only verification number that they have with IRS, then yes, use the I-10, but a social security number ultimately will be better. Is hiring an agronomist to do soil testing and sending samples to lab a farm expense? Yes, it is. You could put that under line 32 as professional services. Are cost sharing funds received from federal or state taxable to the farmer recipient? Yes, they are. We talked about that. In line 13, do we only report custom hire by people who require 1099, or do we report all custom work on line 13, whether or not they but the rule is if you pay them $600 or more, they need a 1099, either a miscellaneous or NEC. What are farrier costs? Custom hire? Yeah, I would probably, for shoe and horses, I would probably say, yeah, they would be custom hire. And if it's over $600 cumulative over the course of the year, does need a 1099. Where do we report expenses for hay and grain we buy? Under feed expense. I will be filing for the first time in several years, trying to start over almost from scratch after pandemic, fires, catastrophic. What is the simplest way to file with very little income against these catastrophic losses? Is there a simple way similar to beginning farmers? There's a lot in that. If you've got some net operating loss carry forwards, just file the return and then start working through those. If depends on, did you make the election to carry the net operating loss forward? I'm just answering off the top of my head. Like I said, there's a lot there. But the simplest way is just file the return and then calculate what those net operating losses are. And then if you don't have anything to carry them back to, make the election to carry them forward. That's the easiest way to do it. And then as you carry forward and get better and more profitable, then you'd have that to offset. I have a W-2 from a current employer. Whether this Schedule F and other expenses come in the same tax return, or will it be a separate? Yeah, the W-2 is going to be reported on Form 1040. The Schedule F is going to report net farm income or loss, and then that's going to go to Schedule 1 as other income, and then comes in as a total netted against other items that are either adjustments or other factors of income, and it'll all be on the same income tax return. Yes. If I rent a space in our barn for other operations, would this go in rent or to another area altogether? The person uses a part of my barn for candle making. If you rent that space in your barn for the candle making, that would go to Schedule E and as a rental income, and you would have to identify, is it a room or is it a barn? And then look at the rental income and then make allocations between property taxes on either a per square footage basis, insurance on a per square foot basis or something like that. Make some allocations between those two activities that go in that barn.
Guido, we probably need to wrap up in like another 5 minutes, so we can probably get another 5 questions or so in.
Okay, I'm doing my best. Do we need to issue a 1099 NEC for hired labor? No, you need to issue a W-2. 1099 miscellaneous. Do I need to prepare it and give it to the person for the work that's done? If it's $600 or more, yes, they need to receive it by January 31 after the close of the tax year. Is there a threshold for 1099 miscellaneous on land leasing? $600 is the threshold. Are property taxes for farmland not paid through farming LLC, but rather paid by the individual owner of the land deductible? They're going to be deductible by the landowner. If the farming LLC didn't do it, I'm assuming there's a rental agreement between the operating LLC and the landlord. The landlord would be responsible for the property taxes. What is employee benefit programs other than on line 23? I'm not sure I understand that question. Can you deduct 100% of the cost of the phone bill for the employee's phone? Yes, if it's the employee's phone, you can. Aforementioned 32F could possibly be negative. How is that? Could be a hedging expense. And that's how you might want to track it as a negative number. That the hedge, if you were hedging grains, it could be that your hedging expense, and it could be that that would be a negative number. How many years in a row can I show a loss? The statute is you have to show a profit 3 out of 5 years. When you get audited, they start counting back. But if you can show that you're going forward, maybe you get by with it. It's playing Russian audit roulette. How are pumpkin farms handled when they are only harvest pumpkins, but they provide pumpkin picking, hay rack rides, and corn mazes? They would go on Schedule F, or would the farm be separated for entrance fees? Yes, you've got agritourism, and it depends on state law a little bit about how that would work out. But generally, I would look at that as a non-farm business, the agritourism, but the sale of pumpkins, and if that's included in the pumpkin picking, you can go get your own pumpkin for $15 and they come out with a pumpkin. You just sold the pumpkin for $15. That's going to be a Schedule F. What if you have over 3 years of losses? Well, it's 3 out of 5 years. And I would encourage you to read articles on hobby farming and hobby losses, because that's where a lot of that good discussion is. Looking at how to deal with that. Would horse breeding, raising for sale, animal husbandry be Schedule F or C? It's Schedule F. Can I explain how farm loss interacts with your other income? Would this count as a loss as a deduction? Well, you calculate your farm loss, negative $10,000, and you've got a $50,000 W-2. it nets it out, it begins tax, it gives you adjusted gross income, for example, then at that starting point at 40,000, then you'll take your standard deduction to get the taxable income. Generally, that's how that works. How do you do with farm losses, money over year, accumulating? How do you do with farm that loses money every year, but accumulating a lot of assets? That's the name of the game. Sometimes assets like land will appreciate, but I see Janet's going to get that shepherd's hook and I'm going to be out of here, but anyway.
And so we thank you so much, Guido, for giving us, your time to go through the slides and then answer these specific questions. But we know we could keep you here for another 2 hours and we still would have the questions coming in. But we appreciate what you've given us and we appreciate your time. Everyone, these questions, some of them can be answered by prior webinars that have been done, and those can be found on farmers.gov/taxes. They could also be found on ruraltax.org and also on agftap.org. So there are a lot of resources that we have already put together that would benefit you and be able to answer some of these more general questions, like the difference between where you put things, Schedule F or Schedule C. Some of that stuff has already been done in prior webinars. And so I thank you guys for joining us. Keep watching the farmers.gov/taxes website for upcoming webinars. We do have them monthly, and we haven't set the exact date for the one in April, but it is coming. And if you are signed up for Gov Delivery, you will receive that email. Guido, unless you have anything else you'd like to add, we can close out.
No, I would encourage folks to utilize those resources at ruraltax.org and other places. We've worked hard to answer some of these questions with more detail.
Great. So everyone have a good day, and we look forward to seeing you next month.
Thank you.